Peloton, the popular at-home fitness equipment company, has announced that it's going to have to put on a hiring freeze after it cut its forecast by $1 billion and shed 35% of its stock price on Friday, continuing a downward trend. It's been shedding market cap for a long time now. It's down 63% on the year. But basically, the at-home workout phase or craze is coming to an end. I think we're starting to see that, and Peloton is starting to see it as the frontline brand probably in the at-home fitness space. They're starting to see that, you know, the upward trajectory or the popularity of working out at home is starting to fade. And what are the implications, of course, from a human capital standpoint? And this story, of course, is a great example of how intrinsically linked business strategy, the performance of the business is, and how closely that's tied to what it means to work at a company, and then also the employer brand portion. So just a few numbers to shine some light on the situation. As of June 30th, 2021, Peloton had 6,743 employees. It had doubled headcount, more than doubled headcount over the last 12 months. In June of 2020, the company had 3,281 employees. So that's massive growth, of course, at any scale. That's a lot of employees to be adding on. And you got to think, too, about these employees, what must be going through their mind right now. The CEO of the company has announced that it's going to have to implement some sort of cost-cutting measures. They said that they're going to freeze hiring, of course, for one. They're going to optimize their marketing spend, and they're going to limit showroom expansion. But stopping hiring is one of those, is step one. And it starts a slippery slope towards layoffs and things like that going forward. So what does this mean for Peloton's employer brand? Over the last 12 months, of course, it's been one of the most attractive places to go get a job. It's one of those hip, kind of young, cool brands that IPO'd. And, there's a lot of wealth probably that's been generated from people that have joined the brand, the company in the last 12 months or the last 24 months. But what does a move like this mean? I think it also shows an interesting idea, which is when you change jobs at the height of, we wouldn't call it a bubble, but at the height of the kind of disruption that's been happening over the last 18 months, certain brands, of course, have over-indexed and outperformed as a function of maybe the stimulus money coming in or the changing habits that people have had to adopt or transition to when they, started working from home. And, different companies become more attractive. But when the market starts to, average out or regress back to the mean, these companies typically, the consumer behaviors don't change that much on a long enough time scale. So these companies fall back to earth, so to speak. And what does that mean for the employees? And this is something that, that I've spoken about with James Phillip on his channel. We have a conversation show there. We talk a lot about how the markets the last 18 months have been a little bit irrational. And companies shouldn't have been making decisions, doubling headcount for one, when things were a little bit abnormal. The idea that Peloton could project out that sales are going to be at the level of the last 18 months is, I don't know how solid that is in terms of strategy. So here's just one of those things. Peloton's market cap has fallen $9 billion. Just in the last few days, which is a ton of money. It's a lot of value that's exited the company. They're going to have to make decisions around human capital now. It's going to be interesting to see what they do in terms of whether they are able to hang on to this 6,700 headcount. Will they have to bring that downsize a little bit, and what that means for the employer brand going forward. So an interesting story to keep an eye on as we go forward.